Welcome back. Okay, so we're in year two. Event number two in year two, JPS purchased on account merchandise inventory with a list price of 11 grand. Now you remember back in chapters 2 and 3, when we talked about on account, that meant that we received goods or services without paying for them. That goes to accounts payable. So we debit merchandise inventory for the $11,000 of merchandise that we received, and we credit accounts payable because we haven't paid for it yet. Event number 3, JPS returned some of the merchandise purchased in event number 2. The list price of the returned merchandise was $1,000. All right, so this is an example of a business having to, for one reason or another, return some of the merchandise that was received. Maybe the guys in the warehouse were playing catch with light bulbs and they started breaking. So they threw the broken light bulbs in a box and took it back to the boss and said, hey, these came in broken. We need to send them back. Whatever it is, you're returning merchandise. Well, you'll notice that when we purchased merchandise, we debited merchandise inventory, credited accounts payable. Well, when we do a return of merchandise, it's just going to be the reverse of that transaction. We're debiting accounts payable for the value of the merchandise we're sending back. So debiting accounts payable reduces it. And we're crediting merchandise inventory for $1,000. So obviously, if we return the merchandise, it's no longer in our inventory. So we have to reduce inventory for that amount. So that's a purchase return. Next, we're going to talk about cash discounts. And you might wonder why a company would give a cash discount. And one of the reasons would be if the company is cash poor, in other words, they don't have a whole lot of cash sitting around to buy more stuff to sell, then it makes sense for them as a vendor to give a little discount on the price in order to get customers to pay faster. And that's what a purchase discount is. So JPS purchased the inventory in event number 2 under credit terms 210 net 30. Those credit terms mean the following. The 2 is the discount. I will give you 2% off the invoice amount. When will I give that to you? Well, if you pay within 10 days of the invoice date. So pay within 10 days, get 2% off. If you don't, the net amount of the invoice is due within 30 days of the invoice date. So JPS received a cash discount on goods purchased in event number 2. The credit terms were 210 net 30. Now you remember we bought $11,000 of goods, but we returned $1,000. So our invoice right now is a net of $10,000. We get a 2% discount on that, so 2% of $10,000 is $200. So we go back to this same principle of reversing the purchase transaction. We're going to debit accounts payable for an additional $200 because that's our credit, our discount, and we're going to credit merchandise inventory because remember from the beginning of our discussion, the merchandise inventory account must reflect what we paid for the inventory. So debit accounts payable, credit merchandise inventory, and that is in response to taking the discount, taking the 2% discount. Next comes transportation costs. And again, we talked about in the very beginning all the costs associated with making the merchandise available for sale is part of the cost that we record in merchandise inventory. Now, we're going to talk about two terms here, FOB, shipping point, and FOB, destination. My definition for FOB, which is not the textbook definition, is free on board. And what that means is free on board shipping point means that there's no cost for handling the merchandise until it gets to the loading dock. Once I put it on the truck, the shipping cost belongs to the customer. So FOB shipping, the customer pays the transit. Now, FOB destination, or free on board destination, means that the merchandise is free of shipping charges until it gets delivered. So FOB shipping point, the buyer pays. FOB destination, the seller pays. And there's a third term called transportation in. That's where the seller absorbs the cost for delivering to the buyer or to the customer. And that's just a period cost called transportation in. I'm sorry, transportation out. Transportation out. Transportation in is another term for this, but it's not typically used. All right, so we had shipping terms of the inventory purchased in event number 2, FOB shipping point. And you remember from my discussion just a couple of seconds ago, FOB shipping point means that the buyer pays the shipping cost. And when the buyer pays the shipping cost, it's included in merchandise inventory. So since JPS paid $300 for the delivery, we're going to debit merchandise inventory for $300 and we're going to credit cash. So that's transportation costs. FOB shipping point, FOB destination. And of course, that's an operating activity on the statement of cash flows. Now, merchandising businesses also have something called shrinkage. Shrinkage is a euphemism, and I suggest or ask you, go look up euphemism, EUPHEMISM. A euphemism is a nice way of putting something else. So, for example, when mom and dad say grandma died, they don't say grandma died, they say grandma passed away. Passed away is a euphemism. Shrinkage is a euphemism for essentially stealing, because for the most part, when there's things missing from the inventory, it means that the employees took something out. So JPS took a physical count of its inventory and found $4,100 of inventory on account. That's a physical count. And every merchandising company does that at the end of its accounting period. Now you'll notice here what they found for JPS is on the books, the ending balance of merchandise inventory is $4,600. So there's $500 of merchandise that's missing from the inventory because the physical count is the physical count. That's what we've got. So we need some way to get these to be the same. And what we do is we record shrinkage or inventory loss, typically debited to cost of goods sold. So we debit cost of goods sold for the $500 difference, and we're going to credit inventory. So that's going to bring this down to $4,100. JPS sold the land that cost $5,500 for $6,200. Now, when we have an investment like that, that's not our business. Remember, JPS sells plants. They're not in the business of buying and selling real estate, but they have seen an increase in the value of the land that they purchased. So what we call that, and you'll remember back in chapter 2, there were 2 terms that we didn't define. There was a list of 10. And those 2 terms were gains and losses. This is a gain. We're going to debit cash for the $6,200 that we received. We're going to credit land for the $5,500 that we paid for the land. And the $700 difference will be credited to gain on sale of land. What makes it a gain is the fact that the company isn't in the business of buying and selling real estate. This just happens to be a gain on an investment. And because it's a gain on an investment, the entire $6,200 goes into investing activities on the statement of cash flows. So that's gains and losses. This is the multi-step income statement that I mentioned before. So again, it's name of the company, name of the statement, income statements for a period of time. And we've got sales revenue of $24,750. We have COGS of $12,000. And they're noting down here at the bottom, that's the $11,500 for the inventory we sold, plus the $500 of shrinkage. So our gross margin is $12,750. We had selling and admin of $5,000, transportation out of $450. Remember, transportation out, that's delivery cost to a customer. So our operating income is $7,300. Then we have a new section on the income statement we're calling non-operating items. Those are like typically one-time things. So for example, we've got interest expense and we have that gain on the sale of the land for $700. Our net income for this year is $7,640. So now you know why we call this a multi-step income statement. Remember back in chapter 1, 2, and 3, it was revenue minus expenses equals net income. This gives us a lot more information. And again, I'd suggest you divide net income by sales revenue to get the profit percentage and get the gross margin percentage by dividing $12,750, the gross margin, by the sales revenue. Here's our balance sheet. We see we've got $4,100 left in merchandise inventory. We still have a note payable out there for $4,000. We have common stock and retained earnings of $25,640. So liabilities and stockholders' equity balance with the assets. We're good. Here's our statement of cash flows. Notice the difference in the statement of cash flows when we add the merchandising business. We have an outflow for inventory. We have an outflow for transportation out. Now we're going to look at what I call the post-Christmas rush, right? On December 26th, what do we all do? We take the stuff that we were given during the holidays and we return it for things that we really want. So this is accounting for sales returns. We did purchase returns previously. Now we're going to look at what a sales return looks like. The customer from event 1A, which was not on, that I didn't include here, returned inventory with a $1,000 list price. The merchandise had cost JPS $450. Now the reason we need both of those is, remember, when we make a sale in a merchandise business, we have a two-step process. The first step is recognizing revenue. The second step is recognizing COGS. So we're going to do the same thing here with the return. The customer returned inventory that had a price of $1,000 and a cost of $450. So the price is going to come off sales revenue. So we're going to debit sales revenue for $1,000 and we're going to credit accounts receivable, because if they return it, obviously they don't have to pay us for it. And accounts receivable is that bucket that holds all the invoices that we sent to customers that haven't been paid yet. Now again, this is A. B is going to be the COGS portion. The cost of goods sold here was $450. So we're going to debit merchandise inventory for $450, because when they bring the stuff back, what do we do with it? The store obviously is going to put it back on the shelf and make it ready for sale again. And we're going to credit cost of goods sold, because if we don't have the sale, we have no cost. So this is a sales return. The collection. Now, for sales discounts, are going to go pretty much the same way a purchase discount is. We're going to get maybe a 10% discount for paying early within 10 days of the sale date. So if they take that discount, we're going to look for 10% of the sale. So in this case, 10% of the sale was $75. So the receivable is now $7,425. And the credit goes to cash, or debit goes to cash. So we get paid. The amount of the invoice was $7,500 less the discount, so $7,425. And this is something that I used to use all the time when I started with a new company. And actually, I would continue it on. First week or 2 weeks, I would take several 3 to 5 years worth of income statements and set them up in a spreadsheet right next to each other. And then do an analysis. Now, what this analysis is doing is taking the percentage of net sales of each of these line items. So, for example, in year 1, COGS was 66.7%, meaning we spent 2/3 of sales to buy the goods that were sold. We're left with 1/3. Now, in year 2, cost of goods sold was 48.5%. And gross margin went up to 51.5%. So think about the things that could cause that. What could cause cost of goods sold to go down? Well, maybe we went out and we shopped around and we found a less expensive supplier of the merchandise that we sell. So if our COGS goes down, that causes our gross margin to go up. We're looking at selling and admin expenses in year 1 were $1,000. In year 2, selling and admin was $5,000. Transportation out was $450. Now, what could cause selling and admin to go up to 20%? Well, if you look at the sales doubled. There may be the cost in here of hiring an additional salesperson or spending more money on advertising in order to increase the sales. So our operating income went from 25% in year 1 to 29.5% in year 2. So it went up. That's a good thing. And typically, companies will use their operating income as the number to analyze the company because the non-operating items are typically one-offs. They don't happen all the time. Operating income is a true picture of how the company functioned from an operations perspective. So now we're going to go to our new section, the non-operating items. We had insurance expense because we borrowed that $4,000, and we had a gain on sale of land for $700. So our net income for year 2 was at 30.9% of sales, and net income in year 1 was 25%. So we had a 20% increase in net income in 1 year. That's a good thing. We like that. A couple of ratios. Ratios, again, are comparisons of two numbers. In this case, we're looking at the gross margin percentage, which I asked you to do on the financial statements before. Gross margin is gross margin divided by net sales. That gives us the gross margin percentage. So what it says is what percent of sales is left after paying for COGS. That's what the gross margin percentage tells us. Now the net income percentage, again, something I brought up previously, net income divided by sales. So what's left of sales after we've paid for all of the expenses? And that really tells you, bottom line, how well was the company managed? How is it functioning? Return on sales ratio provides insight as to how much of each sales dollar remains as net income after all expenses are paid. And that's the number we typically see about companies. They have a 3% net income, a 10% net income. Obviously, the higher the number, the better we're doing. And that ends our discussion for Chapter 4.